Okay, on this example, I want to share something that very few people know. Okay, let's say that this buyer is buying a $350,000 home. Okay, and it actually appraises a $350,000 price range. This buyer, let's say they're buying with an FHA. Of course, down payment is 3.5%. And let's say that buying points or whatnot, the buyer's going to get 5% interest rate. Okay, everything's good, right? Well, not so much. Okay, because this deal fell down. The one that where I was a realtor, I was not the lender, and the reason that it fell down is because here's what a mortgage actually covers. Okay, there's a mortgage, if there's a second mortgage or a third mortgage, okay, everything is going to add up to the total monthly payment, right? In this case, the monthly payment would be $2,822.52. What does that mean? Well, that's the mortgage, and then the insurance. And let's not confuse this insurance is to protect the house. Okay, there's another insurance which is down here that is going to protect the actual mortgage. Okay, and then the county property taxes, we don't set that price. That the county property taxes are what they are, we cannot change that. Okay, and then if your house, the one that you want to buy, it's inside a community that has homeowners association fees, that's why it's called association project dues. Then we divide that amount. In this case, it was $350 a year. You divide that by 12 months, and voila, you got $29.60. So that's why it comes down to everything included, because this is an FHA loan, everything's included, $2,822.52 for this home. Where did it go wrong? Because right here, the lender on the county property taxes was playing with $5,000, $6,000 in taxes, and this property was $8,000 in property a year. $8,000. You divide by 12. This is the amount. He was right here. He was, instead of putting that amount of money, he was putting less than that amount. Okay, and that right there would throw the house in this amount off. Okay, so unfortunately, that lady needs to buy in another area. And here in San Antonio, Texas, everything needs to match. And if your housing ratio, which everybody talks about the DTI, which are the debts, if your housing ratio, if it's too much, taxes, insurance, the stuff that the lender has to deal with, if that's too much, then the buyer does not qualify. And that's exactly what happened to this buyer of mine. So yeah, unfortunately, that lender ain't gonna be my lender anymore. But I thought that this was a neat way to show this to you. I always ask, what are you putting for? What are you using for taxes? What are you using for insurance? But insurance can actually be worked out with your insurance person. If you don't have one, get one in your toolbox. You need to have a good insurance person that is going to work with your buyers for the insurance of the house. Okay, but you definitely need to have a great lender. If I would have been the lender on this situation, I would have told my realtor, okay, taxes cannot be more than this. So look for those areas where taxes are below this amount. If not, this person cannot buy more than so and so. In this case, I got the green light for $350,000, and now that same person, if she wants to buy in that area, she can only buy $275,000. That's huge. I hope this helps you guys. Ask all the questions. We cannot just say how much are they approved for. You need to know how much taxes are you using in your analysis, in your pre-qualification. Okay? Are you using an association fee and all that stuff? Hope this helps.